this is Eric Thompson. I'm the owner and lead investment advisor for Peerless Wealth, a registered investment advisory firm here in Columbus, Ohio. So this one might be pretty simple for some of my viewers, but it might be some news for my others. I've titled it Stocks, Mutual Funds, or ETFs. I want to try to clear up some confusion between these terms and also give you my opinions on what I prefer for clients and why. So if I use the term stocks, stock mutual funds, or equity-based ETFs, that's all a way of owning equities as opposed to, say, bonds, real estate, cash. They're just different ways of packaging it. And I sat down with a client not too long ago, and I was looking at her kind of the pie chart, I call it, of her asset allocation, and I said something like, okay, you're 65% stocks and 35% bonds, and here's why. And she interrupted me and she said, wait, I don't own stocks, I own mutual funds. And I said, oh, that's the same thing. And it's not the same thing, but sometimes people use these terms in the same fashion, and I want to clear up some maybe nomenclature about them. So individual stocks is if you own companies direct. I own 100 shares of Apple, I own 50 shares of Walmart, I own 175 shares of JP Morgan, and there's no manager, there's no index, you actually own the shares directly. And there's some advantages to that. You know exactly what you own. Why is that important? Well, some people, I have one client in particular, her dad passed away of lung cancer. She hates Philip Morris like the devil, and she would never own Philip Morris stock. And she doesn't want to own a mutual fund because their fund manager might buy Philip Morris stock. And so we own individual stocks. Some people don't want to own Anheuser-Busch, or maybe they have political or personal reasons for not owning Disney stock or other names that they don't maybe agree with. And so that's one reason to own individual stocks. The other reason to own individual stocks is you can do better if you pick the right names, especially if you only own a short list, because you know, if you concentrate and you're not overly diversified and you hit a home run with one, you can certainly do better. That, of course, adds risk, but you can do better. And of course, you don't have to, there's no fee drag from a mutual fund or an index provider because you just own the names direct. So that's kind of the pros and cons of owning individual stocks. And now let's talk about mutual funds and ETFs. Mutual funds and ETFs are very similar. Let's talk about mutual funds first. And first, a mutual fund is not always a stock mutual fund. You can have a bond mutual fund, a mutual fund that invests in bonds, a stock or equity-based mutual fund that invests in stocks, a mutual fund that invests in currencies or real estate or other types of assets. But usually when people say mutual funds, they're referring to a stock mutual fund. And these are professionally managed portfolios by a Fidelity or a T. Rowe Price, maybe a Vanguard. They're diversified. They'll own dozens of names, sometimes over 100 names in one portfolio. And the most important thing, though, is they're professionally managed. You have a team of people that work at, for example, T. Rowe Price, that are researching these companies on a daily basis, whose job is to pick the good ones from the bad, enhance your returns, maintain diversification. And the nice things about mutual funds is they have a track record that's audited, and we can look at things like Morningstar and other reports, and we can actually see how these mutual funds have performed, which can give us some confidence in how they might perform in the future. Probably the main disadvantage of mutual funds is the fund management companies charge fees, so that can cut into your performance. And of course, you don't know exactly what you own. ETF stands for Exchange Traded Fund. It's very similar to a mutual fund in that it's a basket of stocks or a basket of bonds. You are diversified as opposed to just owning a few individual stocks. Most often, exchange traded funds are in the form of index-based. They follow an index strategy, the S&P 500. Maybe they only buy companies that pay dividends. That happens to be one of my favorite type of ETFs. Maybe they just own real estate companies. They tend to be more sector oriented. They tend to be more index based. They tend to charge lower fees because they are index based, as opposed to have a bunch of people doing research that have to get paid. But they are diversified, very similar to mutual funds. So what do I like? I tend to avoid picking individual stocks for my clients. There's a lot of exciting stories out there. There's a lot of great companies. It's very tempting to try to do that, but I will tell you this, most of you will not do as good as the averages. Some of you might, maybe a combination of luck and skill, but most of you will underperform the averages. And the best example I can give you of that is, I talk about Warren Buffett a lot, so I'm going to pull up an illustration right now. And this illustration I just ran on software from Morningstar, and it shows you the return of two investments. The first is the SPDR, which is short for SPDR. It's an index provider, and it owns the S&P 500, which is a basket of the 500 largest companies in the US. And it shows the 1 year, the 3 year, the 5 year average, and the 10-year average. The second investment is Berkshire Hathaway, which many of you may know, that's Warren Buffett's company. Inside Berkshire Hathaway is all of Warren Buffett's top stock picks. And there are a couple of dozen names in there. And you can see the comparison. And if we just skip all the way over to the right and we look at the 10-year number, they're virtually identical. The S&P 500 has averaged 12.96 over the last 10 years. Berkshire Hathaway has averaged 12.77. I'm going to call that a tie. So what does that tell us? Well, we have Warren Buffett, arguably one of the best investors in our time. All of the people that work for him, that work for Berkshire Hathaway, all of the resources that Berkshire Hathaway has, picking all the best names they know in an effort to perform. And they've pretty much matched the S&P 500 index. So I'm not too proud to say that I don't think I'm going to be able to outperform Warren Buffett or all the people that work at Berkshire Hathaway. And I don't think most viewers should try to either. I think owning an index, whether it's the S&P 500, maybe one that favors dividends, maybe a low-cost, actively managed fund, I think that's the best choice for most investors. Whether it's in the form of a mutual fund or exchange-traded fund, we're splitting hairs there. They're very similar. I will say this, one of the big advantages of exchange-traded funds is that they're lower cost and they're more tax efficient. So for clients that have substantial amount of wealth in a non-retirement account that generates a 1099 every year on interest, dividends, and capital gains, ETFs don't distribute weird and high capital gains distributions like actively managed mutual funds that trade a lot. Plus ETFs fees tend to be lower. So if I were to favor one over the other, it's probably ETFs. But in short, there's more important things than whether you own a stock ETF or a stock mutual fund. They're going to do pretty close to the same thing in the long run. The bigger thing is, are you saving enough? Are you in the right investment categories, large cap, small cap, real estate? And are you not making emotional mistakes? Are you not making behavioral mistakes? Buying high and selling low and trading too much. Those are a lot bigger concerns than whether it's a mutual fund or ETF. I do tend to stay away from individual stocks because I think it makes people very emotional in their decision making and not as rational. And I think as a group, they'll underperform the averages. So I hope you learned something. I hope that helps kind of maybe clear up some confusion between some of these terms. And I hope to see you next time. Thanks a lot.